Hello, friends. So we've been having a little technical difficulty here because what I've been doing is talking to an empty stream. So if you guys can hear me, why don't you give me a thumbs up because TX is a boomer. And if that's the case, then we're gonna start this over. And thank you guys for waiting. It's been about 20 minutes, I think, of me talking into a dead microphone. So what we're gonna do instead is start this over. How about that? You know, I I hadn't streamed in about a year, and I turned everything on, and then there's like one more button I had to click to make the stream go live, and I didn't do that. So I appreciate you guys hanging out here. But yeah, so let's get this started, huh? Hello, hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. And I am clearly a boomer. So I turned on my OBS studio. It said you're live. I saw all you guys in the chat. YouTube said it was receiving my stream, and I just started talking. And then up in the very top right corner, there's a little button that says Go Live. And I didn't notice this whole time that you guys were waiting for me to click that button. So I'm an idiot, but I am here. I've been here since 11 o'clock. I was on time. You guys were just stuck listening to dead air. So here we are. Good to see you guys. So what we're going to do today, I got XRP on the screen because I actually just talked about Bitcoin and Ethereum before I even got here. So we're just going to do it all over. You guys didn't see any of that stuff. This is amazing. All right. What we're going to do today, we're going to look at BTC. We're going to look at Ethereum, XRP. We're going to look at equities. We're going to talk about some things related to the recession that I think we're going to have. We'll update some of the charts that we've been looking at on my channel that show that modeling. And then we'll just kind of take it from there. I don't have a big agenda, but I do have some points that I want to get through. And so that you guys know, I really enjoy sharing the things that I'm looking at and telling you guys what I've found, what I think is going to happen, showing you my charts. I love doing that stuff. What I don't really enjoy is the multi-hour process of pre-recording a video, editing it, getting everything assembled before then. That whole process is just not elegant for me. And it hasn't been getting easier the couple years that I've been making these videos. So I talked to my buddy blockchain backer about it a little bit, and he said, you know, TX, you should just do more live streams, you know. And I was thinking about it, and I think that's right, because I don't have any problem expressing my views to you guys. I don't need 20 takes to be able to express my view to you. I do it in Twitter Spaces all the time. I go on podcasts and explain myself, no problem. It's really like the multi-hour prep, the sitting and the editing, spending half of my day to put out a video. It's just not time efficient for me at this current stage of the things I got going on. And so it's kept me from making quite as many of them. But I love talking to you, and I love showing my charts. So we're going to compromise a little, and I'll try to do more live streams. You know, we'll try to do them on a fairly regular cadence. We'll just start today. We'll do another one, you know, a week or two from now, and we'll just keep taking it from there. I'll still make other videos now and then, but I want to try doing live streams a little more and see if I can give y'all more regular content as you are hoping for, and maybe fit it into my routine a little better. So now that we've solved our technical issues, let's get into this shit. So what I really want to start with today, I want to do some basic high-level TA on Bitcoin here. I don't want to pretend like we got 4-year cycles, none of that stuff. I just want to think about where we are on the chart and what we would need to see to feel bullishly or bearishly about price, you know, in the relative near term here, right? And then we can talk about the recession and other things like that. This says my video is unlisted. That's kind of weird, isn't it? Shouldn't it be a listed video? I'm gonna check that real quick. You guys are my homies. I'm sure you won't mind me just making sure that this video is visible to all the people who are not currently in the chat, like you lovely folks are. Public, done, save. There it is. Thank you. BCB told me about that. Okay. Thanks. Now let's get into this. I think everything is working. If there's any major problems, then, well, we're just screwed, aren't we? Okay. So if I'm just looking at this chart here, I'm just taking everything, put everything away. Let's just find support on this chart. It's right here. The key pivot, we'll call it, right? It's right here. That's the key pivot. It's the Luna wick from May of 2022. Why is this the key pivot? Because it was the breakdown, swift move lower, resistance, resistance, consolidation, breakout, support, support. So what we're really looking for now is to see if this remains support. And if it is, then we can start feeling pretty good about going higher from here, right? It's just very basically, if we get below this level and we see some acceptance, like lower lows, lower highs on the daily chart, because this is a daily, then we would have to start looking lower. What are those levels? Okay, well, let's think about this. We got one right here. We'll make this a different color. We'll make this in blue, or sorry, red. And we'll put another level. Looks like there's one maybe about right here. Why are those the levels? Because they are places of respect on the price chart. You see this? This was resistance. We got above it for a bit, broke down, resistance again, consolidated at this level before the breakout. So this is the next spot below. Then we have this kind of inefficient couple of candles here from March when we had the bank collapse and then Bitcoin got a strong bid. That kind of inefficiency almost doesn't exist. And you could assume that if price gets back down in here, it's a pretty swift move, right? So I would think that if we get some acceptance below here, like this, my first target from a trading perspective, because I will short this if I see this, to trade it to there and then trade it to there. I'm not suggesting you do that. I'm not giving you any advice. I am a trader. I try to trade these markets. I'm trying to get better at it. And that is the way that I would be looking at it if I saw the price action behave in this way. Now, I'm not going to predict what's going to happen from there. We'll take it from there if it happens. But just from where we are on the price chart, those would be the next two levels if we break down. Now, if we don't break down, what's above us? Well, we've got a couple of interesting levels. We've got one right around here. Make this blue. We've got one as well right around here. I'm going to call it, yeah, this level. We'll say that. Why are these levels important? Okay. Again, same thing. You see respect, resistance, strong breakout, tries to find it as support, strong candle below. Again, just kind of chopping here. Once we got above it, it acted as support. It was the floor for that really hideous consolidation. And then once we got below, strong move back to the key pivot, right? Because of the inefficiency here. The same thing that you could logically expect. You see this? These mirror each other. So if we get below this level right here, you would logically assume a quick trip to this level. Now, I don't want that to happen. I'm not hoping for 20,500 Bitcoin, but just looking at the chart, having no emotion about it whatsoever, that's what I would think would happen. So what I'm thinking is because we had this swift move down, we need to see this get back up here. And this is kind of a tough area to get bullish in, right? Because we've had all this action, because this has been such annoying resistance for so long that it's really hard to get mega bullish down here based on some candles in the middle of this range. Now, maybe someone smarter than me who's better with fractals, maybe the homie BCB, maybe he sees some things in the tea leaves that a pleb like me doesn't see. But just from my perspective, you know, I might trade this as a little breakout. If I see this little breakout here, invalidation, target, target. But I can't really feel like the Bitcoin chart is in a better place until I see action up here accepting this level, because that's not what we've seen, is it? Look, wick, 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 wick. The one time it closed, we got a huge rejection just a couple hours later as the candle rolled over. So we need to see acceptance above all of this stuff. I can't get super bullish right here. I might feel like the chart is recovering. Maybe it starts looking better as we go higher. But I really need to see this conquered and forgotten about, and then we can start looking higher, right? And then where would we look higher from there? Well, let's zoom out the chart a little bit. This is how I look at it. I'm not telling you this is right or wrong. Other people will look at it other ways, and that doesn't matter to me, because what's important is that you find something that makes sense on the chart, that is both respected by price and that you can recognize. Because all you're really trying to do is turn all of this fucking chaos into something that makes a little bit of sense for you, to give yourself a fence, a boundary in which to do some business as a market participant. That's all that matters. So I don't really care if someone else thinks that my levels are stupid. They make a lot of sense to me, and they help me read the market a little better. And I see a level right here. Why do I see this level? Because this is another inefficient move, just like we had these inefficient moves here, right, that we've been talking about. That is an inefficient move. And before that, we had strong support before the breakdown. And once this level was lost, swift move below. It then acted as resistance on all of these candles. So then again, here we are with resistance. So if we get up here, boop, 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 we start doing one of these, then I'm pretty bullish. I will legitimately be bullish on Bitcoin up to here. And then from there, we'll take it from there, right? And then we will reassess. Once we get to 37.5, we will look at the market. We will be looking at the economy, and we'll decide, okay, are we bullish up to here? Is that the next step? One thing at a time, friends. That's my perspective. No reason to get months out ahead in advance, because it is not material to me. So that's kind of how I'm looking at Bitcoin right now, what I'm hoping to see. This yellow line is the key. It's the one we're hanging out at. And so that's what I think is most important. Let's go look at Ethereum real quick. We'll do something similar here with Ethereum, but we're going to do a little twist on it. So let's just delete all my drawings. And let's flip it upside down. I posted this yesterday. I don't know how many people knew I was posting a chart of Ethereum. I did this after I was talking with BCB a little bit. We text actually pretty frequently, talking about the markets and stuff. It's good to have a friend that you talk about markets with who doesn't look at exactly the same stuff you do. I don't look at the same stuff he does. We have completely different skill sets when it comes to analyzing the market, and so we can complement each other in that way. He can say, no, I think that's stupid. That's not the way to look at that chart. And I can say, hey, that fractal you just drew lines up with this economic data I'm seeing, and here's why. So it's a great compliment to have a friend like that. Anyways, that was a sidebar. I posted this yesterday after I talked with him, and this is the Ethereum chart, right? It's upside down. Let's do the same thing we just did to Bitcoin. That's the key pivot. Why is it the key pivot? Resistance, strong move above, support, strong move away. Came down, tested the area, didn't really test the level, but tested the area. There's support, moving away, right? Let's draw a little more structure on here. What else do we got? We got a line up here like this, like that. And we've got some other horizontal levels that I can see. We've got this key pivot. That's clearly, this operates the same way as the Bitcoin yellow line that we just drew. What we really need to see for Ethereum's, fate to be changed is for this level to be conquered like this. Now, if it's a strong move through, I would expect a back test, because that's usually what happens, because that would be an inefficient move, just like this, right? It's the same concept. But if price grinds its way up and starts to do that before the breakout, I'd start feeling better about that level. I'd start feeling like maybe it's been reclaimed, and then we could start looking down here, right? So I've forgotten to draw a couple other of my levels. I'm just so excited to talk about this stuff. Let me just go ahead and finish my TA. So let's draw another level right there. And then we'll do another one right there. Why are these levels important? I'm framing it this way because I want you guys to see my thought process. Some people out there don't know how to do TA. And also it helps me to more build in my mind kind of my best practices. So that's why I'm talking through it this way. So we've got these lines, right? Why are this first blue line important? Resistance before the breakout, support before the breakdown. Same thing again. Look at this. Look at this respect. You see this? This level's broken. Swift move down. Then it's support. Then it becomes resistance, and we move down to the next key level. So this is a very important pivot within this broader range, right? Within this big range right here. That's kind of the midway point. So we're above it now. From our perspective of the chart, we're above it. So this kind of looks bullish from this perspective, knowing that this is upside down. So if this car starts moving away, then I would think the next target is maybe here and here, because this is the range that we're in, is it not? This one right here. So if we start seeing price action except below these wicks and structurally moving away, then I would think that the next targets are 1400 and maybe 1250. Just logically, looking at the chart, there's no reason why that can't be true if price continues to behave in this way and move in this direction, right? However, it breaks down, we start going this way, and we actually start reclaiming some of these trends, then we can start maybe tilting our bias. Maybe it's starting to recover. Maybe it's starting to turn some of this structure into a support, well, from this perspective, it would become resistance instead of it being support. Well, if we start to do that, we start breaking lower, then I'm going to start getting pretty, well, from this perspective, it would be bearish. I would be expecting price to go this direction, right? So if we start getting over this level and we reclaim it in this fashion, then what's the next target? It's there because of the inefficiency. It's this level here, which is about 2,800 on Ethereum. Remember, this chart is upside down. So when I flip the chart, it's really good for kind of resetting bias. And if you draw levels the same way we drew them on Bitcoin just a few minutes ago, we have another spot above current resistance, just like on Bitcoin. This is the same as the 37K spot on Bitcoin right here. This is the 32K spot on Bitcoin. It's exactly the same. So if we reclaim this, I would be bullish on Ethereum for a relatively rapid move back to 2,700. And then we would reassess from there. Maybe we then look to come up to this level. Maybe something else is happening in the economy and we have to reassess. But just from a level to level trading perspective, the perspective that I have about it, I don't really care about Ethereum. It's not something I study. It's not the focus of my investing. It's just another asset in this market that I find interesting, and I try to trade it if I can. That's how I'm looking at it. But we've got some work to do. We have to get back inside this range first. We are currently in this range. And so I am worried that if price starts to curl lower, we're going back down to there, or at least to here. And I don't think anyone really wants to see that. This needs to become support for us to maintain some structural integrity here. And really, it should reclaim this trend line, for being honest. That is the 2023 trend line. Look at it. It started in December. Bitcoin had the same one. It broke the same thing. Really needs to get above here and then move up here. That's bullish. So that's kind of what I'm looking at with Ethereum. I'll do XRP real quick because I know I got a bunch of XRP types in the room. This one I'm going to do on a bigger perspective, though. I'm not going to zoom in quite as much. I'll leave that to BCB. But I'll share what I looked at the other day, and that was the quarterly chart of XRP. So there's a couple of levels here that I thought were pretty interesting, and they related to previous yearly highs, right? So this one here is the 2019 high. I'm going to mark it so we can see it more easily, like that. This is the 2019 high. This here, whoop, my line, there we go. Oh no. This is our 2022 high. We're going to make this yellow. Make that stand out. 2022 high. So Why did I think this level was interesting when I was looking at it? Now, again, I'm not talking about cycles. I don't have any historical fractals for this. Just looking at support and resistance on a high time frame. That's it, right? This 2019 high was kind of an interesting place because it was a bearish retest of the prior bull market floor. You see that? This was the floor of the bull market and the bear market. This was the floor of support in this cycle of the market. Once we broke down below this level, that was the retest. It was the retest and the rejection. And when it was rejected, price went lower for another year and a half, right? It came here in this Q4 of 2020, tried to break above it, came all the way back down to this lower level, right? And then, of course, we had the breakout in 2021. And once it got above this level, it was support. It marked the floor of the next bull market. What had been the bearish retest of the prior bear coming out of the bull marked the floor for the next generation, right? And it was the floor for the entirety of 2021. And then at the beginning of last year, XRP broke below this level. And what happened? That same spot became resistance again. And here we are in the middle of 2023. And we have this interesting quarterly candle that just formed here. And this quarterly candle came all the way up to last year's high, swept the high, and then came all the way back down in like a week. Now, when I posted this chart the other day, the price was actually below the red line. Let me get my drawings off of here. Bear with me. When I shared this the other day, this candle was like this. It was down here. And I said that, we still have time. We have over a month left on the candle. Don't get ahead of yourself. But just the way it was forming, the way it looks on the high time frame, I wouldn't want to see this quarterly candle close below this line, just because I don't think it would be a good look. And so someone asked me, well, why is that not exactly the same as this candle right here? Well, because this candle was a breakout of two different levels, right? Oops. You see this? This was the floor of the bull market. We had the breakdown and we had a second floor. We tried to get above it. We couldn't, and we broke down a second time. This line right here would, in this current cycle, be the equivalent of this line. So this breakout isn't the same. This would be the equivalent, this candle right here would be the equivalent of XRP spending a year and a half below 33 cents and then breaking above it. That would be the same position in the cycle of this particular candle. Now, I'm not saying it can't go higher or anything like that. That's not the point. The point is simply the context of the candle in its given cycle. And so I just thought this was a pretty hideous 3-month candle on XRP. And I would think that if you're bullish XRP, that you ideally would want to see it above this level of, what is that? 50.5, 50 and a half cents. You'd want to see it above there before the end of next month. That's just my feeling. And then the candle doesn't look quite so hideous. However, if it's one of these, that's pretty ugly. And I wouldn't feel great about what the next candle would look like. I'd start to think maybe we get one of these or something like that. So just speculating, just how I'm looking at it. Again, this is my perspective. This isn't right or wrong. Others will have different things they find important. DXY. That's what I want to look at next. So let's go look at it. Let's actually pull up a new chart here because it's got my drawings on it. Yeah, there we go. DXY. Okay. So here's DXY. Now there's some funny things about this. Now we've been talking about ranges, right? DXY is currently in a range. It's actually this range. It's this range from the middle of 2022 before we had the massive breakout. And in a way, so we see this, see the support here? This became a massive deviation on this range. Trader SZ would be very proud of me for saying that right there. That's just a massive deviation on an existing range. You see that? Back inside it, it's resistance again. It's resistance again. We're just back inside the old range. So we have to look at it as back inside the old range. So what does that mean? Well, we found it as support. We found it as resistance. We found it as support. We came back up. This is kind of the mid-range, this dotted line here. This is the mid-range. We got back over it. We stopped about 3/4 of the way up. And then we came down for this move here. This was what really got my interest because this looked to me like a Wyckoff spring. Now, I'm not a Wyckoff expert. Some couple people in the chat, our friends, know a lot more about it than I do. But I'm trying to get better at recognizing it. And so I actually tweeted this on July 17th. I tweeted the DXY and I marked out, hey, I think this looks like Wyckoff. It looks like we're forming a Wyckoff and that we just had the spring. It looked super clear to me that that's what it was. And what's really kind of funny is look where my tweet was. It was literally the pico bottom of what I thought was the spring on the DXY. And when I tweeted this, I got so many replies of people telling me I was an idiot. There's no way that it can do that. Haven't you heard of what's going on in the macro situation? There's no way they'll let that happen. DXY's going to 90. This is the beginning of the bull market. TX is an idiot. Blah, 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 blah. I literally ignored all of that and just looked at the chart. I said this looks like a spring. And what do you know? A month later, we're all the way back above the mid-range and it looks like it wants to go higher. And I would say that since we had this move and we swept the entirety of these stops, it would make sense to me that we come back up here. And that's why I said I think the DXY is going to 105. It wouldn't make sense to me, not saying it can't happen, but I think there's less of a chance that it did this move, comes up here and then just goes... then it's just over. That's less likely to me than a retest of the top of the range first, maybe even takes out those stops. And maybe that's the move, right? Maybe it takes those out and then it's just straight down. That could happen as well. But that's a little ahead of where we are now. The main point being that we're in a range. We are respecting that range. We came back in it after a massive move on the DXY last year that everyone thought was mega doomtown. And it created a lot of problems in the global markets. If DXY if I'm right about this, if it's going to go back to 105, I think there's a dynamic in play. That dynamic is how quickly does it do that? Does it do it in one move? Does it do one move even higher? Or does it just kind of, like drunken walk its way up there? If it does this, I think equities and Bitcoin and whatever else could do fairly well. They at least would not be hindered by the behavior of the DXY, right? But if the dollar decides to go on a massive squeeze up to new highs, then everything's going to take a shit. So I think that the pace of this move, now that we're getting above these, we got above these recent highs, these equal highs here, we took them out. If we get back up towards this level, just depending on the pace of it, I think that's really what I'm looking at for the dollar index here. I don't think it's going to just do another one of these and go up to 150. I mean, some things would really have to start breaking down. But just from a momentum perspective, it looks like this is the next spot. What else? Oh, yeah. Next up, I want to talk about small caps for a second because I've been trying to look. I showed this to BCB the other day. I've been trying to just figure out what is similar and what is different about this current market versus other markets that experienced a bearish drawdown, a bear market drawdown of 20% or more. What did they look like in recovery when they weren't a recession? And does that look like today? Is there anything I can glean from it? So what I decided to look at in white is the Russell 2000. In red is the S&P 500. Okay, the Russell 2000 are like small cap equities. It's like the 2000 3,000. Russell 2000 is the 2,000 smallest caps in the index, for lack of a better explanation. There's a lot of banks in there, small banks in there, but there's also just a lot of other smaller companies inside the Russell 2000. So it represents broadly small cap US equities. So what I want to look at, these are recessions, these bars. This is an indicator I have. If you want this indicator, go on TradingView and look for TXMC recessions in the indicators. You'll find it. It's public. Use it. These are recessions. Here's the S&P. Here's the small caps. What do you notice about the bottoms for both of them? They are at the same time, right? So when the major index in red starts to recover after the recession, this is in 2000. Sorry, I meant to start in 1990, but it's the same thing. When the recession you're coming out of the recession, equities are recovering. Small caps and the larger index, they go together. Like we were just looking in 2000, same thing. When the market bottomed in 2000 was 2003, as the index recovered, small caps recovered and in fact led the recovery, right? And we even see, this was in 97, 98. This was the long-term capital management crash. We had Asian contagion. There was some issues with like Thailand, Malaysia, some of the other Asian countries. They had some debt issues in the late 90s here, and long-term capital management went under. This was like a 30-something% drawdown in small caps, 36% drawdown in small caps. Bear market in small caps. What did they do? Shot back out into the tech bubble. This is the tech bubble right here, the top of it. If we had the NASDAQ on here, it would be shooting up above the screen. But you can see how small caps joined the rally in the tech bubble. Everyone thinks that we're in a tech bubble now. You would think we would be seeing this behavior in small caps. Hold that thought. Let's move ahead. Great financial crisis. Again, same dynamic. Small caps, large caps, all recovering at the same time, and they follow each other. What are we looking at today? Look at the difference between these two. Look at this. The S&P is up massively, and I believe the Russell is up half as much. The Russell 2000 is 10% and change off the low. The S&P 500 is 24, 23% off the low. These two are not behaving together. They are not behaving in sympathy. The small caps are telling you something is wrong, because even as the S&P has now set higher highs, we're now all the way up into this territory, right? Look at small caps. They're still below their August highs. This was Jackson Hole. This right here was the last Jackson Hole symposium by the Federal Reserve in August of last year, when Powell came out with like an 8-minute speech and basically said, all you bulls are stupid, we're going back down, and the market crashed. We're about to have another Jackson Hole today and tomorrow. We'll find out what Powell says, I believe tomorrow, which is Friday. I'm not saying it's going to do this exact same thing again, but just for context, for market context, small caps are suffering while the regular index is going higher, and that is different from the last 30 years. So something is going on here, and I think that this is telling part of the story, that perhaps it's the S&P who's wrong. Perhaps it's growth stocks that are wrong. We don't know just yet, but this is a puzzling component that is different from prior eras, and it suggests to me that small businesses in America, smaller businesses than the large caps in the S&P, they have more pain ahead. That's what I think this means, and it kind of is confluent with some of our views about recession. So that's kind of what we're looking at with equities. We're going to talk about the recession charts. We'll look at the soft landing comps and all that stuff here in a second, but before I get into that, I'm just going to pause for a moment and just kind of look over at the chart, or I'm sorry, look over at the chat and see how you guys are doing. I see the chat going by. How many people we got here right now? It says we've got 162 viewers. Bummer. We can get more than that. How many likes do we have? 100 likes with 100 viewers? That's a pretty good ratio. You guys are hitting that like button with alacrity. I enjoy it. Thank you. So Let's talk recession, okay? We've got we're we're in a tough spot right now. So the market looks okay. We talked about how Bitcoin and Ethereum both have a little bit of work to do before they're back in a confirmed bullish zone. We need to see Bitcoin claim 32K and move away from it before we can say it has been conquered. And so if we see those things and the market starts going higher, then what really becomes important are the charts we're about to look at together, and not really what any of the price charts are showing, because they will be one of the last places to confirm what this data is showing us. So right now, as we've shown on the channel, maybe the best place to start is this chart here. What we've been looking at are a bunch of different measures of the US economy in prior recessions. And what we are in right now is what I've been calling a pre-recessionary window. And during that period of time, going back about 100 years, we can find really consistent sequences of events. That sometimes the order is a little bit jumbled in which thing happens first or second or whatever, but there is a process to the slowdown of this economy, and it's relatively similar across the eras, even though each era has unique factors. So if we just kind of put aside all the narratives and the stories and the things, well, this time we've got all the stimulus, and what about COVID, and you know, we've got not enough labor, and like there's all these unique factors to 2022, 23, right? But you can ignore all that stuff and just compare the economy broadly to prior eras and find a lot of alpha in that data. So what we're looking at right here, this is the trajectory of non-farm payrolls, which is one of the primary measures of labor strength, of jobs, in relation to yield curve inversions going back to 1968. You can see we've got a bunch of little eras down here. Those of you who've watched our recession series are already familiar with this chart. But what you're looking at, this is the jobs market for each of these eras. This is when the recession began at each of these posts. This black line is 2022 and 23. It's right now. You can see the growth of non-farm payrolls is not historically high. It's not historically low. It's actually smack dab in the middle of all prior eras. And in fact, if you look at these three, which are the three currently above our present era, those are the three eras most associated with high inflation markets. So it kind of makes sense. We have a period of high inflation, high demand, we have strong labor growth, right? Those things kind of go together. And so where we are, we're above these other eras, which had lower inflation, like 2000, 2007, 1990, things like that. But it tells you a couple of other things. It tells you that we are months away from the place where labor starts looking weak on average, right? You can see that average here. This is the same chart as this one over here, but it is an average of all of the growth rates put together. And when you average them, we do look like we're a little bit higher than the historical average, but only by a little bit. You'll notice over here, it's like 0.2%. But when you split them all out, you can see we're kind of in the middle of the pack. Part of that is because the job growth in 2000 was really poor. It's actually really low compared to all of these other eras, so it's kind of dragging that average down. But again, what happened? It was, another 4 months from this place before 2000 saw negative payrolls. It was another 8 months, 9 months from this place right now before 1981 and 82 saw negative payrolls. And keep in mind, this is the recession everyone's compared us to, because this was the one where Volcker jacked rates up to like 19% and we had the worst recession since the Great Depression. This is the one people thought we were going for. And we're still months away, another 7, maybe 8 months away from lining up with when labor weakness showed up in that market relative to the yield curve inversion. Now, the 73-74 market was even harder to read because it was 20 months, 21 months, almost 2 years after the yield curve inverted before labor collapsed. And this was actually a really ugly drawdown for the stock market. And it was one of the worst recessions. It was the worst post-war recession until the GFC, until 1980, and then until GFC. So 1973-74 was pretty bad. But again, labor continued to grow for a long time. And when you hear people talk about 73-74, a concept they bring up a lot is labor hoarding. There was a reticence among business owners to let go of skilled labor because they didn't believe that there was going to be a downturn. They didn't quite accept it. And there was a lot of distortion in the market because that's what inflation does. It makes it hard to decipher real organic demand from inflated bullshit. And so there was a lot of confusion and kind of misdirection. This was the birth of people talking about soft landings. This recession right here was the first time it got mentioned. And it faked people out for almost 2 years. So where we are right now, if we look at the average fractal, we're a few months away from starting to see this growth rate really slow down on an average historical basis. So I'm thinking by the end of this year, it should start being more clear to us if we're going to follow a trajectory like that, or if we're going to look like a soft landing. So what does a soft landing even look like? Well, I've got one of those charts. Where is it? Here. This is a soft landing. This is the exact same chart as this one, but I've added 1966, and you can see 1966 just keeps on going. Non-farm payrolls never bows over. It just keeps on going after kind of a period of slowdown. And there's a lot of comparisons we can make to this. I made a video about this last month. I think it's the 2 videos ago. It's called The Soft Landing, and you can watch me break down these charts in detail. But the real takeaway from this is that 1966, out of 100 years of data, is the only example we have of an economy getting to this juncture that it is at right now in terms of cyclical drawdowns, rate of change, all that kind of stuff, yield curve inversion, Fed tightening, how high CPI went in this cycle. If you overlay all those factors and you look at the prior times all of those things have happened, once did we avoid recession. Once. And it was 1966. Now, I don't think that this is 1966. It's not an exact comparison. But there are similarities. They had a lot of stress in the financial system. There was a ton of debt issuance to pay for the Vietnam War. We had high inflation. We had a tight labor market. We had higher unemployment because we had more labor growth. So there was an outswell of supply of labor that was far more than the demand for it. So we had higher unemployment during that period. But we also had a really strong economy. So I'm watching this 1966 fractal. And this is a different way of looking at it. So over here, I made 1966 this red line. And this just shows you non-farm payrolls relative to the yield curve inversion. Well, this chart over here is a little bit different. This is actually the 6-month rate of change. So it is non-farm payrolls. It's the job number. But it's how fast is it growing on a month-over-month basis. And I thought that this was interesting because let me show you this other chart. I think it's, where's my other chart? Sorry guys. Oh, here it is. Okay. I'm going to show you this one to set up the one that I just teased you with. So this is non-farm payrolls. Again, the same thing, the same job number we've been looking at. This is the 6-month annualized rate of change. So every 6 months, how much did it move? What would that look like if it happened for a whole year? That's this number. And what you'll see is job growth since COVID. You can tell which one is COVID. It's this massive spike. Since then, the growth of non-farm payrolls has been insane. It's been all the way up here. It's been above the last 40 years of job growth. You see that where my red dot is going across? That was the trough of job growth in April of 2021. We've finally broken below that level. The rate of change of job growth has slowed down, and we've now returned to the high end of the average between the great financial crisis and COVID. So all that extra job strength that Biden talks about, that all the politicians want you to focus on because they don't want you thinking about recession, that has gone away now. and we have returned, for the most part, back to our 10-year average between the last two recessions. So if we take that forward, we say, okay, the rate of change of jobs is slowing down. What does that look like in prior recessions? So this is that line. You see this gray line here? This is the average growth rate of non-farm payrolls in all prior recessions on average. And this purple line is 1966. So what we're looking at is probably another 4 to 6 months of data on this black line, which is 2023, needs to fill in before we could really start to see maybe it's looking like 1966. Maybe we're not going to have a recession. Maybe we're going to, ooh, that's yellow. We can't do yellow. Let's do black. Make my line thicker. Maybe we're going to do one of these, right? But we can't actually know that because right now we're actually following the historical trajectory pretty damn close. And it's getting a little concerning to me because this chart lined up with all of the other things we've been studying about recessions says to me that we're on an almost unavoidable track. It's going to be really hard for us to avoid the same kind of outcome that has happened more than 92% of the time. We have one example of it not happening, and it was this one. And oh, by the way, they had a recession 18 months later. They still had one. It just happened in 1968 instead of 1966. So the context here is very important. And I think right now the key piece is, what does non-farm payrolls do? Does it keep going this way? Because right now we're in like month 9 or 10, right? We're gonna get the 10th number here pretty soon, and this line will jump forward to up here. And if we go ahead to, let's say, Christmas time, and we're on this part, and non-farm payrolls looks like this, brother, 1966 is going the other way, right? It looks significantly different. And labor is the last piece to go. That's why it's important that we watch this. So that's kind of what I'm looking at for the soft landing. I'm watching the growth of jobs. And today or yesterday, they released these massive job revisions. Let me see if I can find that chart for you guys really quick, because I actually tweeted it yesterday. We're going to go find this real fast. Because what's been going on is all the job numbers that have come out have been getting revised lower over and over and over again. Where is it? Oh my gosh, it vanished. I tweeted it yesterday. All the job numbers have been getting revised lower, and all the housing numbers, here they are, have been getting revised lower again and again and again and again. And so non-farm payrolls is about to have a massive revision to the downside. There's supposed to be like 300 something thousand jobs that got taken out of the last year of job growth. And so if that's true, when I update my model for the next time we talk, that could drag this line down in kind of a stepwise fashion, right? It's not gonna mean it goes down like that. But what it might mean is that it's down here, right? Instead. It might be a little bit lower as a general baseline than what we've already been seeing if we get those kinds of revisions. And that will be another notch in the recession camp and another hit to the 1966 thesis. So that's something to keep in mind. I will update that model soon. But, if we just look at this era, objectively, look at this era, job growth is right in the middle, right? But there are places where we look quite alarming. So real retail sales, we're near the bottom of the distribution. There are a couple of places that it was worse than it is today. However, we are in contraction like many prior eras, and we're near the bottom of the distribution here. Real manufacturing sales, we are currently at the bottom of the distribution, meaning that the rate of change of real manufacturing sales, wholesale sales, is lower on a rate of change basis than every prior recession since 1968. That's not a good comparison. That's actually a fucking horrible comparison. Industrial production, look at that. Only 2000 was worse. Real personal income, Only 2000 and 1980 were worse in growth rates on real personal income. And remember, that's adjusted for inflation. So all these inflationary eras built into here have already got those adjustments, and we're still trailing below them. Additionally, there was a couple of other ones. Where was it? Oh yeah, bank credit. Look at that. Bank credit is dragging along in contraction, and every prior pre-recessionary window did not even see a negative value in bank credit. They were all above the zero line, and we are in contraction. Same thing, I think, with bank loans. Yeah, look at bank loans. The actual creation of credit out of the banks is all the way down here at the bottom of historical comps. And I can even show you this in a different way. Here's credit growth. Let's zoom in a little bit. Sorry, my chart's a little laggy here. Let it catch up. This is credit growth on a year-over-year basis. My labels are really ugly, but I can talk you through it. This orange line is business loan creation, commercial and industrial loan creation. It's negative year over year, meaning that we're actually below the levels of total credit for consumer and industrial loans versus this point last year. So they are not creating loans for businesses right now. Banks are not. Same thing if you look at bank credit, which is both the loans that they've created and it's the securities and treasuries and things that they hold on their balance sheets. The value of those has been coming down. And as well, just the general creation of loans out of the banks, if you consider consumers and businesses and you put them all together in one big pile, it's coming down and it's almost back down to zero. It's at the lowest level it's been since back here, not counting COVID, since all the way back here in 2011. That's the lowest level of credit creation we've ever had. The only thing that is still positive is consumer revolving credit, right? It's households taking out more debt on their credit cards. That's not a sustainable dynamic for households on into the future, right? They can only maintain that for so long. And there's actually a way that we could see this stress in a different way. I'm going to make this chart for you guys real quick. Personal interest payments. Let's pull this up. Yeah. Personal interest payments. This is all consumer non-mortgage debt, right? So it's all the obligations that they have that is not their home. So their credit cards, their personal loans, their auto loans, any other money that they owe that is not their home. This is the debt service cost of that debt. So how much they're paying in payments as a percentage of their disposable income. So the reason I want to show this is because there is a different chart that people have been showing a lot. Household mortgage debt. Where is it? Mortgage payments income. There it is. Mortgage debt service payments as a percent of income. So a lot of people keep showing this chart and saying the consumer is not under stress because their mortgages are not under stress, right? And that's true because a lot of people refinanced in 2019 and 2020 and 21 when rates were really low. They locked in sub 4% mortgage rates, and those people are not affected by interest rates on that part of their obligations. So when you look at mortgage debt as a percent of income, it's still quite low and it doesn't seem alarming at all. But if you then take the mortgages out, you get this chart. And it's showing a really concerning trend. It shows that we are all the way back at the levels we were at the end of the great financial crisis in terms of debt to income for everything besides people's houses. Now, that doesn't mean that the consumer immediately is going to crater, but this is showing you that there is stress building in the consumer cohort. We also know that sometime in the next 2 months, they are going to start paying back their student loans after 3 years of forbearance. Some people haven't even paid student loans since they graduated before COVID, right? Like there are people who have not paid on anything since 2019. That is going to change soon. It's going to be hundreds of dollars a month for a lot of Americans. They're having debt service costs on their credit cards and their personal loans skyrocketing back to levels it hasn't been at in 13 years. And everyone is just looking at this chart. And I think it's a little tone deaf. So the consumer, I think, has headwinds in front of them. And when you look at my chart of loan creation and you see that consumer loans, which is this blue line here, consumer credit, is the only thing that's really holding up the current credit edifice. And then you see that they are rising in their stress, the amount that debt service is costing them. I think that there's a breaking point on this, and we can't expect consumer spending to be the lone leg of the stool, people's incomes to be the lone leg of the stool, because that's what's going to happen when people cap out on their ability to access credit, which is coming before long. You can see it on this chart. So I'm concerned about the timeline there. I think we've still got a few months ahead of us before growth in employment really starts to show its hand either way. And this is kind of Thanksgiving, Christmas area, assuming nothing happens, assuming that this doesn't just like absolutely tank. That would give us our answer. But if it just kind of keeps drifting like this, it's going to be really hard to read this market. But we can see, looking out ahead, recessions are in front of us, right? We are right here. Recessions are out ahead of us. And these are just the ones since 1968 that I'm showing you. If we used other perspectives, if we looked at other things like the drawdowns in key metrics used by the NBER to date recessions, which we've talked about on my channel at length. If we looked at which things are drawing down, industrial production, real manufacturing sales, real retail sales, and we see that those three things in concert with each other go into contraction before all recessions. And then we see that our growth rates today on all of those 7 metrics, all these metrics on this page here are the same 7 listed here. Our growth rates today in these red lines are below most of these black lines. Where are we ahead? Well, real retail sales is choppy. We're ahead on that one a little bit. But where we're really actually trending ahead is on employment growth. That's about it. On all of the other comps, real incomes, on real consumption, on combining everything together, we're trailing below the historical comps. And this is what it looks like on a chart altogether. This black line is all those metrics over here, all these metrics that the NBER finds important, these same metrics here, if you combine all of them into one big growth number, they're this black line. This red line is us right now. And now we don't know if we're going to have a recession. We don't know when it's going to be dated. We don't know when we're going to get negative non-farm payrolls. But we do know that the rate of change of cyclical measures and coincident measures of the economy are showing you a fate that has played out 90+% of the time. We haven't seen one of those outcomes since 2008. COVID was not one of those outcomes. It was a recession, and it was 2 months long, people. That's not the same thing. That was an artificial shock, and we didn't allow any of the malinvestment to be wrung out of the system. That is the key point. Malinvestment needs to be resolved at the end of a recession. That's how you get sustainable growth coming out of the recession. 2020 was not that. 2008 was that. And so when I think about all that, I know I'm going on a big rant here. I've said a million things without even looking at the chat, but there's just so much to say here that it's so important that we remember. Where's my bear market chart? It's so important that we remember that when the yield curve inverts, if we look at every time the yield curve has inverted and we include the Great Depression and we include 1966, on average, the yield curve inverts 19 months before the low of the market. And in fact, in no instance prior was the low of the market before the yield curve inverted, except this time. Which means that that's probably not the low of the market, guys. I mean, either this time is different from 100 years of data, and we just don't know it yet, or we're still in the early innings of something that has not fully manifested, which is what it looks like to me when you look at all of our other charts. However, that's not what people want to believe. Even if we just look at the recession, right? Yield curve inversion start, months from the recession, 11 months. Okay, so the yield curve inverted in 2022 in October. So even if we were to just smack the average right on the nose, our recession wouldn't really kick off until October, until the beginning of October, if we hit the averages just right. But I don't think that that's what we have in store here. I don't think that October is going to mark the low, because I don't think that this time is different. I think that for the economy, this time will be proven to be like all of these other times, with this one exception being kind of a weird anomaly. Will we get another one? Very possible. There's single-digit percentage odds that this happens again. Certainly, it could. But there's an overwhelming amount of evidence, a preponderance, that suggests that's not the case. And so if that's the case, if we do have a recession, it's not going to be obvious to anyone when it starts. People will disbelieve it. The stock market will climb until it has a reason not to climb. And when it becomes apparent that we have a recession, and when the market turns over and starts going lower, and we look back in time and we see every prior recession when that happened. I don't even have to look at yield curve inversions. I could also look in the 40s and the 50s and the early 60s when we had yield curve control. Not the 60s, but in the 50s and the 40s, I could look when we had yield curve control. I could bring in all the prior recessions and see, okay, how old is the lowest low that gets violated when the market crashes in a recession? How far back in time does it erase price action? Well, on average, more than 2 years, right? This x-axis is the number of years between the low of a recession and the price that it violated in the past, right? So when the GFC bottomed out in 2009, in March of 2009, it took out a low that was 12 and a half years old. It was 58% down from its all-time high. This was the fractal. And at that moment, it touched a price that had not been seen in almost 12 and a half years. There are only 3 instances right here of a recession occurring and a low less than 2 years old being the low. Meaning that if we wanted to assume that October of last year was going to be the low of the market, there is about, what is this? 1, 2, 3 out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. 3 out of 13. 23% chance. There is a 23% chance, based on this lens, that if we have a recession that begins in earnest, that we might be able to preserve, I should say, the October low from last year if it starts sometime soon. However, what's more likely is that when the recession kicks off, lows from 2.5 or 3 years or further in the past will be up for grabs. And that means October 22 is not safe. So this is what frames my perspective on risk assets. I've breezed through some of it. We could really get into the nitty gritty on some things, but I think I should come up for air because I've been talking for like an hour straight. But it's so important to keep in context what happens to the economy in a recession, the pieces that unfold. There is a big sequence of events that is consistent. Some of you have seen me share this chart before, and we're still early in the process, right? All these things have happened right here, all except the end of tightening has not happened yet. And yield curve inversion ending has not happened yet. But all these other things have happened. New orders peak, housing permits peak, yield curve inverted, the low of unemployment, earnings peaked. The market reached its high, at least for now, it reached its high. The peak of industrial production, the peak of CPI, new orders contracting, real sales peaking. So we're in this box right here. We're waiting on this event And then what is the next event? It's the recession. And then it's the beginning of easing, right? Then the Fed starts to ease. And then we have the troughs in all of the markets, real income peaks deep into the recession, and then you see a bunch of these things troughing and ending, and this is the recovery. This is innings 7, 8, and 9 of the baseball game. This is innings, 4, 5, and 6. And we're still right here. We're still like in the middle of the 4th inning, maybe the 5th inning of the baseball game. And we don't really know how it's going to play out, but we have a consistent sequence. A sequence so consistent that I've got 100 years of data on this chart right here, and it's forming a perfect fractal. You see that? Like occasionally things will be out of order, but when you average all of these series together, there is a sequence. We are right here. We are waiting for this. So if you want to watch a chart, if you just want to watch one chart and you don't have access to my rate of growth of, jobless claims or anything like that, the chart that I think you could watch is the US 10-year minus the US 3-month. Watch this chart. My drawings off of there. Watch this chart. Let me put a 0 on here so we know where the 0 is. Boom. This is the chart to watch. If you want to watch anything, watch this one. TradingView won't show you all the history, but take my word for it. It comes out of inversion right before every recession. If you see this motion right here, whoop, I would have started getting concerned. It's not a guarantee that it plays out that way, but it does 90% of the time. That's kind of what I'm looking at. If you want to boil everything down to one chart, we're still down here. We're waiting on this movement. And when we see that movement, the flight to safety, that's usually how it's characterized. People characterize that as a flight to safety, a bid on the front end, right? A lowering of rates on the front end of the curve. If that's how it plays out, that would be the warning sign. If this goes up because the 30-year yield is breaking into new highs, that would probably be more concerning, but we'll save that talk for another video. Just watch the yield curve. Just watch what it's doing here. Watch for it to get back towards 0. So that was about an hour rant. I didn't realize I had so much to say, so sorry for you guys just chatting away and sending me questions and comments. I haven't been paying that much attention to the chat. I just got in my mode, you know what I'm saying? But I do want to look back here. What do I got? Let me look at my... Oh, I got some super chats. BCB, $20. When moon, sir? Just text me the date so I sound like a genius. Okay, thanks. Mark said, TXMC, thanks for the valuable data you've shared with us. I'm more prepared because of it. Hit the like button, everyone. Thanks, Mark. I really appreciate that. Amron Jeffrey, reminder for everybody to drop a like. Yes, please. If you haven't hit the like button, we have 180 people watching. I have 170 likes. That means 10 of you ain't pulling your weight. Got me out here dropping insane alpha about the economy, showing you things literally no one else is showing you in this way. I just need a thumbs up from you, all right? Cash me outside. When shall Bitcoin's value ascend to the cosmos? Well, if I'm correct about the economy, okay? If I'm correct about the economy, and we do have a recession in the next 12 months, and risk assets go lower as they do in recessions, then I expect Bitcoin will go lower. I expect that it will break this low. And if it breaks this low, I don't think that it's going back up here anytime soon. I actually think it's going to be quite a long time. It could be another couple years. I don't know. It depends significantly on how the economy handles whatever comeuppance there is coming its way. I put that term playfully, but I'm talking about serious events here. And I'm really careful about expressing this bias because it's really easy to say, well, I think if we have a recession, Bitcoin's going to struggle to make new highs. It's very easy for me to say that, and then for mouth breathers on Twitter to say TXMC doesn't believe in Bitcoin anymore. TXMC doesn't think Bitcoin will ever go to all-time highs ever again, blah, 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 blah. And I didn't say any of that, right? I'm just taking a perspective here that if you go back on this price chart and you look from this point right here, there's a vertical line, this point right here. The US, the United States, the largest, most financialized economy in the world, the one whose economy does move the markets more than anyone else's. That economy and its sister economies, the EU and some others, with some brief interruptions, have been in a relatively uninterrupted expansion. The globe, I should put it, has been in a relatively uninterrupted expansion throughout this process. We've had a couple of interruptions. We thought we were going to have a recession right here. We thought maybe we were going to have one back here. We thought in 2018, when we had the Christmas Day massacre in 2018 and the markets just absolutely shit themselves, people thought there was going to be a recession right here. People thought we were going to have a real downturn in the middle of 2019 when the yield curve inverted and some things started to look a little ugly. We didn't though, right? We had the COVID shock and then we shot back out of it. But during this whole period, during this whole expansion, Bitcoin's had these beautiful symmetrical cycles, right? And during these smaller oscillating cycles, the larger economy has just been in one big one, right? But what's about to happen now? What's about to happen now is that Bitcoin did one of these and it went down, and now it's going to start trying to come back up, right? But the thing is, it's been aided by this long arc of expansion in the bigger economy, the larger global economy from which it derives its fuel. So I'm going to make that one a nice big thick line, and we'll make Bitcoin a little skinny line here. Oops. To kind of get my point across. You got Bitcoin in its little cycles here, and then you've got the global economy doing one of these. And if I'm correct, it's about to start doing one of these. And the real question that people in crypto need to ask is, forgive the scale of my doodles here, but what I'm trying to get at is Bitcoin thinks it's doing one of these, and the economy is going to start doing one of these. And so if the economy is, for the first time in Bitcoin's life, going to start going down for a period of time, maybe a year, maybe 2 years, who knows? That's how long it usually is, a couple years. Then it's really hard to fathom a world where Bitcoin gets to just keep doing that while the global economy does that underneath it. That's just not realistic. What's far more realistic, far more, not just for Bitcoin, but for all risk assets, is that they start doing one of these and they follow along. Because this is the tectonic force, right? This is global liquidity. This is credit conditions. This is the status of the US dollar, which is the global reserve, right? This is monetary policy from every major central bank. If everything bows over, then Bitcoin is not going to do that. It's going to follow the trend. And it has never seen that trend because this hasn't happened since 2008. 2020 didn't really happen. 2020 started to do this, and then we came out with nuclear stimulus, and we went like that, right? So Bitcoin just got to keep following that cycle. But now everything is turning over, and so the smaller cycles inside will follow. That's the simplest way that I can explain it. It's a wave function. And the sine wave of Bitcoin will be threatened by the larger sine wave of the economy. And that doesn't mean that it permanently is incapable of going higher. It just means that it will probably take longer than anyone thinks. And it probably means that it's not just going to bounce off of this line right here that everyone keeps drawing. I don't even know if BCB is still in the chat right now, but he'd probably agree with me 100% on this, that if Bitcoin comes down, oh wow, my super thick line's still there. If Bitcoin comes down and it breaks that low right here, it's not just going to bounce and then go higher. All of this structure is broken. And this isn't really support, right? I mean, it might find a reaction here, but this was actually a long period of consolidation. This whole area was. If you were in this market and you have a stop, it's either right here or it's here. You don't have a stop right there. That's not a logical place. Now, that might be a place where price reacts. Maybe we get a reaction back up into this level, and then we come right back down. That's what I think it would do if we have a real bona fide global recession. And to just kind of put the final point on this global recession conversation, these are the PMIs for 9 different areas, right? There's 2 colored lines. The colors are awful. I would have liked to counsel this person on their color choices. However, it's showing you manufacturing and services PMIs for a bunch of different countries. And they are showing you that we are headed for a global recession. We have the UK, both services and manufacturing are in contraction, actually surprised to the downside recently. Germany is already there. They already have 2 negative quarters of GDP as well, which a lot of people count as a recession. France is already in contraction in both layers of its economy. The Eurozone broadly is, which you would assume if France, Germany are there. Italy's services are holding up, but look at their PMI manufacturing. It's way down here, 44. China, again, not looking so great. And the news out of China in the last week is firmly in the camp of recession. If anyone thinks that China abandoned draconian COVID-0 policies after 2 years of medieval restrictions, if they abandoned that overnight and that they were going to reopen because things are going well, I've got a bridge to sell that person. I knew from the moment I saw that was a red flag, and I don't really know much about China at all. They have major debt problems. A lot of the territories inside of China, the provinces, have significant debt burdens, and their income does not match it. And the Chinese government is cutting rates while their stock market tanks. So for everyone who thinks that rate cuts are bullish, look at the Hang Seng Index, my friends. This is a central bank that is cutting interest rates right now. What is the stock market doing? It's literally eating shit. This is the same thing that happened in 2008 in the Great Financial Crisis. When there is an actual deleveraging, when the capital that all of the debt claims to own is touched, then you have a deleveraging. Right? And when that happens, it doesn't really matter what the central bank tries to do. They can't stop all of it, right? They couldn't stop it in 2007. If we go look in 2007 and we look at Fed funds, different percent scale, sorry. Pin to new right scale. We go back here. Oops. Fumbling a little bit with my mouse. Here we go. This is the Great Financial Crisis. The red line is interest rates. They cut in September of 2007. It says June, but it was really September was the first cut. I think it was August, September. They cut, the market went sideways, right? It rallied at first when they first cut interest rates. It found a local low and then it bounced. This is part of that move that everyone's like, oh, every time they cut, it's super bullish. There was a massive run in 2007. Yeah. Sure, there was. It barely made a new high, and then it rolled over, and we know what happened. And what was the Fed doing? They were cutting rates the entire time. So you reach a point where you've pushed the system too far. And now it doesn't have to look like this, but there are many examples, many such examples. This is just the one I pulled from. So if we have a scenario where multiple countries, including China and the US, the 2 largest, and the Eurozone, the largest single unified market in the world, if all 3 of them are drifting into a recession, the entire world is going into one. It won't be obvious. No one's going to stand up and wave a big flag that it started on like a Tuesday, in October when it begins. But the trajectory is pretty clear. And if you look at it objectively and you don't pay attention to the stock market, it tells you a pretty unambiguous story about the trajectory of the global economy. And so perhaps this doesn't play out. Like there is a percentage chance that it doesn't, though it is low. I think it would hinge upon a productivity boom. We need some kind of productivity miracle that allows us to have real growth and actually work out the debt to GDP problem that everyone has. If that hits, people think it's going to be AI. I don't think AI is ready yet. I think AI is where the internet was in 1997. But maybe that's what it is. Maybe that's what comes. Maybe sometime in the next 12 months, actual productivity starts to be improved by what AI can bring. But if you look around the market, like we looked at small caps earlier, the only places that seem to be responding to what all of the promise of AI could bring are the very tech stocks who are talking about AI on all their earnings calls. Like none of the other companies in the other sectors of the economy who would actually benefit from massive productivity bursts, they are not following this rally. They don't yet seem convinced. So I think there's a little bit of a disconnect there, and some of it is shown on what small caps are doing here. They're just absolutely ignoring the S&P as we looked at earlier. Right? Catching up on the chat here. I really appreciate you guys hanging out. I didn't know how long we would go. I hope I haven't missed any of the super chats. I scrolled back. I saw 3 or 4 of them. I hope I got you guys. This is a bit of a clunky process. We had like 20 minutes of dead air at the beginning of the stream. I'll try to do better about that next time. But I'm just a one-man show, just a regular dude trying to figure this stuff out. If you enjoy the content, please subscribe to my channel. Please give this video a thumbs up. Please set your alert buttons so that when I post new videos, you watch them in relatively short order, and that helps with the algos. Share my content with your friends. I have 70-some thousand people following me on Twitter, and I would say at least 40,000 of them don't even know I have a YouTube channel, even though I tweet about it all the time. So I think that it would be really helpful if you guys share my content with your friends and, get the word out. What do I think about China solving their problems through stimulus? I think that there's probably some restrictions on how much they can really do. Now, they have a command and control economy. They're communists. They can control a lot more than the United States, Western economies can. But I think when you look at what they did this week, where they only cut by 10 basis points, it's almost like an unserious level of interest rate cut. And it was the second or third unexpected interest rate cut in the last couple of weeks. And I think that without understanding all the dynamics, please, I'm not a China expert, right? I'm just a fly on the wall, an American fly on the wall on the other side of the world, by the way. I think that there's possibly some limitations to how much their stimulus can actually help things. And you have to really think about the differences between our economies. I mentioned that they're communists, but what I mean is they're consumers, right? Chinese households are not consumerists the way that Western households are. If you look at US GDP, 68% of it is people spending money. It's consumption. It's you and me buying shit. That's how our GDP grows. China's GDP is from building stuff, infrastructure, manufacturing, the things that the US used to be really good at in the 60s and the 70s, right? That's what China makes their money from. We converted into a consumer economy. They're trying to do that, but they have like 25% youth unemployment. Most of the provinces are upside down on their debt obligations, which mostly consists of real estate. And real estate is in all of the pension funds for Chinese retirees. They're in a real fucking pickle Whereas Americans have mostly the stock market in their 401ks, their pensions, I should say. Americans mostly have exposure to stocks in their 401ks. In China, it's real estate. And for the last 15 years, they pumped out infrastructure project after infrastructure project. They incentivized bidding. They gave them rebates. They compelled local provinces to buy their own land from themselves, which is how many of them became overly indebted. And they have a bunch of buildings that no one's living in that are not producing output for the economy. They just got built and slapped into someone's pension fund, and now they're worth nothing. And they're going to have a comeuppance the way that commercial real estate is going to have a comeuppance. So I think that China is in a very difficult place. And people just assume that central banks can always turn the money printer back on. But what I think is probably a factor, and it's not one that anyone's really had to contend with, is just how much they used the money printer 3 years ago, right? We created 40% of all the money in existence in an 18-month period in 2020 and 21. You cannot simply do that again 3 years later if the economy has a downturn, if you have any hope of preserving your economy into the future. You will create hyperinflation and a massive dollar crisis. You just simply cannot do that feasibly. I'm not saying they won't try. I'm not saying there won't be stimulus. I'm not saying there won't be lowering of interest rates and probably some money handed out to people and things like that. But the kitchen sink, broad bore liquidity cannon that they launched in 2020 after COVID, the combination of fiscal and monetary that all major governments did. The US did the most of it, but every economy did. China did less of it, but they were already in a bad spot with their debt because of this real estate problem. You cannot just simply 3 years later do the exact same thing again. The Treasury and the Fed realized that they created a dysfunctional treasury market by allowing quantitative easing to run for too long. The Fed was an active buyer in the market, a price-insensitive buyer in the market for so long that they essentially publicized the market. Private participants started going elsewhere. They started dabbling in other debt markets and in other instruments. And there wasn't nearly the same kind of robust liquidity that you need in the biggest and most important market in the world, which is US Treasuries. And that because the Fed played an outsized role in it for 15 years when they shouldn't have. And I think they're very sensitive to that. And when you look at how confident they are in their tools and their ability to deal with a crisis, you hear Governor Waller and Governor Williams, those are two different Fed governors. They talk about how their bank lending program in March was an example of how good they are at managing crisis now and how people don't need to worry about the next time we have a downturn because they'll just create a new facility. Well, we created a lot of facilities in 2008 and we still had the worst recession since 1929. So it doesn't mean that they can stop a problem that they have created if they let it go too far. I think a lot of governments are in a really tough spot right now where they have awakened inflation. It might not be the 1970s inflation, but they have awakened it. It was not a factor for 40 years and it is now returned. It is returned at a time when almost every developed country has 100% or more debt to GDP. Well, in 1980, most of those countries had 20 or 30 or 50% debt to GDP. It was half or a third or a fourth of what it is today. So they're in a real tough spot. And I think that there's just so many complicated forces in the market right now that to assume that we will get the same kind of response that we got in 2020 is a bit short-sighted. To think that the market would then react in the same way that it did in 2020, I think is also misguided. And so I think that this is the big one. I think that this is the real daddy of our generation. Doesn't mean that it's going to look like the GFC. It could look very different. But I don't think that this will be mild. I don't think that this will just be a bump in the road. I think we're in for a pretty severe recession. I think that means 3 or 4 million people losing their jobs, which is, you know, I mean, we have a workforce of 160 million people. So if you have 160 million people and 3 million, oh my God, that's not the right number. If you have 160 million people and 3 million of them lose their jobs, well, then unemployment goes up by 2%, right? That's all it takes. That doesn't mean that 90%, 98% of people, 95% of people might still have jobs, 90% of people, but a lot of people will lose their jobs. Commercial real estate is going to have a reckoning. All these zombie companies that have termed out debt into 2024 and 2025, they will have to refinance. That will affect their margins. They will cut headcount. All of these small cap companies right here that just don't see any positive prospects, even though the S&P and the NASDAQ are saying, hey, you got a lot to be excited about. That is a giant fucking red flag. So, I apologize if I bounce around a lot when I answer these questions. I'm just kind of giving you a stream of consciousness of the stuff I think about when you guys ask me things. There's a lot to consider. There isn't just one chart we can look at. There isn't just one number that's the answer. There isn't just one solution to the recession. It's not just, oh, QE, money printer, go burr, V bottom out of here. If they do that, they're going to create something worse than 1929. They will create something worse than 1929. So I seriously fucking hope that we do have a recession, because I do not want to see them try to pull 2020 again. I don't think they will, but I think that anyone who actually hopes for that and whose bags are aligned on that specific outcome is playing with the most dangerous kind of fire. Eric says, love the diversity of this conversation. Appreciate it, man. I see a lot of familiar names in here, and I see some of you guys in my comments on Twitter, and I haven't always been super good at replying to those. I'm trying to get better about that. So I'm trying to engage a little more with you guys. I tend not to read my replies all that much, but recently I've been trying to get better. And Eric, I see you in my replies, homie. So you're one of those names I recognize, along with several others. I don't know that we're going to have runaway inflation, Rufus, but I do think it's going to be a factor. And, you know, we talked about before, we looked at a couple of videos ago. Where's it at? A couple of videos ago, we looked at the rate of change of inflation, didn't we? And we looked at it on a few different rates of change. And what I said in the prior video was that the year over year of CPI was probably going to go higher, because if you think back to last month, let me cut this date off my chart here so we can see it. If we go back to last month. Oh, that's not it. Okay, this month. There it was. So this was what the chart looked like, right? Last month. And we had the black line, which is year over year CPI. The black line for CPI was all the way down at 3%. So it was at 3%, but all these other measures, which are 3-month, 6-month, and 1-month rates of change annualized, all those values were higher than 3%. So I said that on the next CPI print, we were going to have higher CPI for the first time since last summer. And that was dead on accurate. I completely nailed it. And I think that we are in store for maybe a little more chop in that regard. I don't think that we're going to get another 1970s wave of inflation. I would be surprised if we do, because I don't think the setup is exactly the same. But what did we get? A bounce in year over year inflation, and all these other metrics are now coming down. On a 6-month annualized rate of change, a 6-month basis, CPI is up 4.4%. So that's a full percentage point higher than the current year over year number that is always reported on the news. So I think it is still possible, though not a guarantee, that over the next couple of prints, CPI just keeps chopping along, just keeps kind of doing one of these. It doesn't have to keep going straight down, guys. It also doesn't have to go straight back up. This isn't the 1970s. This isn't necessarily the Great Depression. I think that what's more likely is that we get one of these. And if you look at CPI historically, that's what it does. I think I got another chart of it on here somewhere. Yeah, here's a chart. Yeah, so this is CPI. And we can see it gets these periods where it just chops sideways, right? Even in the double dip of the 70s, we had a period where it just kind of chopped around for a little while. So I think we could be in one of those periods. It doesn't have to just keep going straight into the ground. But if we get a recession, it will. Do I think rates will go to zero? No, I do not. I think the central bank realizes a couple of things. One, zero rates were the only thing that was avoiding a debt spiral. They've now kicked that off. So you'd think maybe they just go back to zero rates. However, zero rates is also how we got to where we are today, with dislocations in markets, major asset bubbles, high volatility in the treasury market, which needs to be the most liquid market in the world to have financial stability. And a lot of that is because the Fed ran zero rates for far too long and was a buyer in the market. So I think that they are loath to return to that era, and I think that they will try not to. I think that it's more likely that rates will come down. Rates will come down, but I don't know if they'll go to zero. It will really depend on the severity of the downturn. If rates are all the way back at zero, it's because we're in a depression, in my opinion. I don't think we go from 5 to 0 without that happening. I think it's much more likely that we come back down to somewhere around 2% on Fed funds, 1.5%, 2% on Fed funds. And that's just kind of where we live for the foreseeable future until something else happens. Thanks for the pointers on the UK metrics. Yeah, I'm not an expert on the UK for sure. I don't live there, and there are dynamics to their economy that aren't exactly the same as they are here. But they look like they're drifting into a recession. If you look at real GDP per capita for the UK, it looks awful. I think I can pull that chart up real quick, actually. I think I have that on Twitter. TXMC trades, UK GDP per capita. Yeah, look at this. GDP per capita for the UK is still below the pre-COVID high. That's terrible. That's GDP per person, right? They're in a really tough spot. I think Brexit was a horrible decision for them. And then you add COVID on top of that, and they're just they're just in a real tough spot. They're our biggest ally. They look like they're going into a recession. Or where is it? Down here. They're going into a recession. China's going into a recession. The Eurozone is going into a recession. The US is probably doing the same thing. Have I read Soft War? No, I bought a copy of it, but I haven't read it yet. I was a little put off by how much of a douchebag Jason was on Twitter, so I just decided not to read his book just yet, but I will read it. All right, so I think we're going to start trying to wrap up here. I appreciate you guys sticking with me. Still 150 of you in here. This was a little bit clunky. I didn't really manage my time very well, and I will get better at this process. We'll try to maybe have more organized thoughts at the beginning of the videos, and then spend more time talking with you guys if that's what's necessary. If that's what you want, and that's what helps the stream. So that's kind of what I'm thinking about. I'll be traveling next week, so I won't be able to do a stream next week. I don't think my laptop would handle that, but I'll be back for the week after, and we'll do another one. How am I preparing for all this? How does the average consumer prepare for all of this? Okay, so I'll answer that real question before I wrap up. I've handled it a couple of ways, and this is not advice, right? Like, this is me with my investments. I'm not a wealthy person. I don't own a shit ton of assets. I don't have a history of working in finance. So don't listen to me. Just make your own opinions. Let me just couch that. I was buying Bitcoin last year at the lows because I didn't know it was going to happen. And that was around the time I was building my recession modeling that we're now using today. I felt like something was happening. I felt like a recession was likely, but I really didn't know. And I didn't know when it was. I didn't know how that would affect Bitcoin, if it would at all. And I was still forming my thoughts. But I bought BTC because we were at the lows. We were below the realized price. We were below the 200-week moving average. Every on-chain indicator said that we had bottomed, and I had no idea what was going to happen. So I was buying some BTC. And I have that. So I've been long the market. But everything else that I've done with my funds since then has gone into treasuries and high yield savings. I'd rather be liquid by rotating my money in and out of treasuries at 5% every 1 or 3 months than to sit all of it in a risk asset that I don't have confidence in its performance. Right? It's not because I don't have confidence in Bitcoin long term. It's because I don't know what it's going to do if we actually have a recession. My models say we're probably going to have one, and risk assets go lower when we do. So I haven't continued allocating to BTC. I haven't bought a single Satoshi since Q4 of last year. I put all of my excess money that I would have put into other things into treasuries and a couple of savings account yielding over 4%. You shop around, you can find them. And it's because I want to stay liquid, right? Because I would rather earn 5% on my money that I can get pretty much any time or in relatively quick basis, a quick order, earning 5% while my level of uncertainty remains as high as it is. If my level of uncertainty begins to come down, then I can start moving some of that money somewhere else. But I think right now that's the best place to keep it, is to stay liquid, whatever that looks like for you in your environment with your investments. In my opinion, I'm trying to stay flexible, to stay nimble. I'm not worried about catching the Pico low because I am exposed to an asset I think is important. I have my Bitcoin. I still have some other stuff from the previous cycle. I actually own a couple ETH and I have some XRP still. I had some other like shit coins, but I consolidated all of those into Bitcoin last summer. It was shortly after Luna when I felt like we were going to have a pretty bad altcoin bear market. So I consolidated, but I kept those core three, and Bitcoin's by far my biggest holding. I don't have large amounts of the other two. But everything else, like I said, is pretty much in cash or cash equivalents. And that's my choice. That's what I choose to do. And if I start to feel like we're going to pull ourselves out of these doldrums and actually have a period of expansion, I don't know what that's going, I don't know how that we could do that from where we are right here, but it's possible that we could. So if I see that, then I'll reallocate a bit. I'll probably buy a little more BTC, maybe some other things too. Don't forget your immediate needs: food, water, security, shelter, etc. Exactly, dude. If we have a depression, and my base case is not the big D word, but I think we're going to have a pretty severe recession. And sometimes those can become depressions. If we actually have that, the most important things are canned food, shelter, and bullets, right? It's not Bitcoin. It's not an XRP. Like you might want to buy those things when you perceive a turn in the market or something like that, but those aren't the priority items. Someone just said, Eric says, I was going to gift memberships and realize you can't. Yeah, sorry, I haven't turned those on because I haven't been streaming and I didn't want people subscribing for something that I wasn't guaranteeing any kind of value for, right? But if we're going to do streams more regularly, I need to get some cool emojis for my chat. I don't have any. And B, I need to turn on memberships in case you guys want to be like subs to my channel. So I'll work on those things. I'll talk to BCB a little bit because he's already been doing this for a while and he's my homie. He might have some good advice for me to do that. But yeah, you can do super chats, but I haven't turned on the memberships yet, but we'll get into that. First time I'm watching. Really like your content. Much love. Thank you, David. Just me. I'm just one guy doing my own research and talking about what I find interesting. I don't work for anybody. I don't have anything to sell. I don't have a service that you need to buy. It's just me and my thoughts. How how low are we talking could be the fall in case of a recession? Like I said, it's this chart. It's not a percent. It's time. I chose to look at this through a time-based perspective. Now you could go pull up TradingView and you could average the percent drawdowns of all the cycles. And I'm sure I could pull that number for you really easily. But it's kind of all over the place. It's everywhere from 20% to 60%. So it's a big range. But what is pretty consistent is this cluster right here. Let me turn off my tooltips. This cluster right here of about 7 recessions that all took out lows that were 2 to 3 years old. So if the low was in October of 2022, then we should really hope that if we have a recession, that it's 2 years away from 2022. Because if so, then maybe we have a chance of preserving those lows. Maybe it doesn't start until 2024, late in 2024. You know, if everything's going great for 12 more months, well, my fractals will show that. We'll look like we're in a soft landing. We will look like 1966. And then maybe the low from October 2022, which will be 2 years old by then, maybe it'll be preserved. Something to think about. I don't have the It's Wednesday, my dudes queued up here. Sorry guys, wrong stream. But all right, I think we're going to wrap it up. I don't really have a cool outro for this, so I'm just going to tell you, we're going to wrap it up here. Make sure you hit the like button. There's more likes than there are viewers, so we did a good job. 200 likes, that's dope. Thank you so much. We will probably do another stream week after next because, like I said, I'll be out of town next week, unless we do it on like Tuesday. You know, maybe but that's pretty soon to do another one. I don't know how much more we'd have to talk about, but for sure, we will do one week after next when I come back. Make sure to subscribe to my channel. If you're not following me on Twitter, I am right here at TXMC Trades. I do not have an Instagram. I do not have a TikTok. I don't have Telegram. I don't have a Discord. I will never message you and ask you about your portfolio. I won't tell you to subscribe to my private group. If you ever get hit up about any of that stuff, that person's a straight up scammer. All I do is tweet on Twitter and talk on this channel. That's it. If it's not one of those two places, it's not me. But that's where we'll leave it, friends. Thank you so much. Until we meet again, take care of yourselves. I know that I shared a lot of bearish information. It does not mean it's the end of the world. It just means you should be prepared. Don't get overly committed to a direction that isn't quite guaranteed. And just stay nimble. Just stay flexible, stay liquid until we are less uncertain about the future. There is nothing wrong with waiting until there is more clarity. No one ever lost money doing that, okay? People lose money by getting ahead of themselves and not letting the data play out. That is why we do what we do on this channel. That's why I am painstakingly slow in talking about turns in the economy, because they don't happen overnight. This is a multi-year process, and we are probably in the 5th inning of a 9-inning baseball game, and we don't know how it's going to end. The score is tied. So I love you guys. Take care of yourselves. Don't get down about this information. Just be prepared for it. Talk about it with your families. Think about what's best for you, and just be aware of what's going on. The people on Twitter are not going to give you alpha. Love you guys. I'll talk to you soon. DM me on Twitter if you have any questions. My DMs are open. And I will talk to you guys in about a week and a half. week and a half, 2 weeks. Okay? Cheers, everyone. Signing off.